All right, today's podcast, I got Karl Gielau here. He's a mortgage broker, and I've invited him here because Karl does some pretty interesting things. But let me just say this about mortgage brokers, because I've worked with mortgage brokers for a very long time, Karl, and I have seen the good, the bad, and the ugly. And it's very interesting in the mortgage world. I actually don't understand every in and out of the mortgage world, but I do know that I've seen some mortgage brokers who bend rules, maybe find the wrong lender for the client, and maybe they're paying a little higher interest rate than they should, or maybe into a situation where it's hard to get out of that mortgage if they want to sell early. Like, I've seen all of these situations, and I've come to realize that the average person that's getting a mortgage tends to focus just on the interest rate. And they don't tend to focus on all of the other things that go on with mortgages, but it's like, oh, what kind of interest rate do you have? Oh, you can beat that. Maybe I'll go with that lender, with no real thought to it. And maybe you can correct me if I'm wrong, but I don't think too many people actually read their mortgage.
No, definitely not. There's lots of fine print. I mean, some of them, depending on the lender, some of them are 30 pages long, right? With lots of fine print.
Yeah.
And as for the rate, the problem is, because that's all that people are taught, right, is rate. Well, like you said, there's bona fide sales clauses, right? Like, there's other things that you can't do in your mortgage to get that super low rate, and that's where the fine print comes in. You need to read it, or, well, really, you should read it yourself. Ideally, maybe put through AI now and have AI read it for you and look for something, right? But yeah, the point is, read it and know what you're signing before you sign it.
Yeah. That's the down for a lot of people, because I'm on the selling side. I mean, I'm in the real estate side, and I go to list their house, and they find out, wow, boy, getting out of this mortgage isn't easy. I had no idea that my penalty was going to be this high, or whatever the other case is. I've run into that so many times, and then all of a sudden they're mad at their mortgage broker. Why didn't that mortgage broker tell me this? I had no idea, that I was going to have such a high penalty. So, this is why it's really, really important to understand what you're doing with mortgages. And I love what you just said, though. Even have AI read it. I mean, get it summaries, but somebody, AI or your friend should read it. You should read it. Maybe your mortgage broker could read it to you.
I've done that. And
You've done that.
And the problem is, when someone's buying a house, they're going through a lot of stress. There's so much going on, right? Even though I've gone through and be like, hey, if you break this, your penalty is going to be substantial. And often clients are just like, yep, you bet, okay, because they're focused on, the mover, the timing of the houses. Like, they've got so much going on that, yes, they're listing, but they're not understanding all the details.
Makes sense. So, in case in point, that's why you're here. Now, Karl, I got to say, I've met a lot of mortgage brokers that have never come from the background that you come back from, and which really intrigued me when I first met you, because I thought, wow, you have an engineering background. So just tell us a little bit about that. I mean, going from engineering to mortgage brokering, that is an anomaly.
Yes. Yeah, I've been told that a lot, being that I don't have a finance background. So, I mean, first off, it's math, right? Like, doing mortgages, which I find, honestly, mortgage math is pretty easy. I use spreadsheets a lot in doing engineering. I use spreadsheets a lot doing mortgages. And paying attention to detail, like, that's obviously required in engineering, all engineering. It just transferred, like, these skills have transferred well for me into mortgage brokering. As for, like, why the change, and that's, I mean, obviously, 2015, the oil crashed. I was off work for quite some time. It made me look around to what else do I actually want to do, and I really enjoy actually helping people find their home or their investment and set themselves up for a better future.
Mm-hmm. So you got a little bit of passion in there.
Oh yeah.
Yeah. Engineering was not as much passionate.
Engineering was good money. It allowed me to do what I wanted to do, right? But yeah, the joy of engineering definitely faded over time. I mean, I did it for almost 30 years, so there was a lot of history there. But it definitely changed in around 2015.
Right. Well, I think you just brought up a good point, though. It is mathematics, and again, I don't know a lot of people think about that when they're just getting a mortgage. I think, again, it goes back to what I said earlier: interest rate, what my mortgage payment is going to be, and that's what most people really focus on, right? But there is a lot more to that, and I do know, even when you're working with a client, I mean, you have to present the client to the lender and more or less sell the client to the lender, do you not?
Yes.
Yeah.
Oh yeah, that's why we ideally you want to get the whole picture, right? Not just, okay, how much cash do they have? Here's the credit score. Like, no, we actually, I want to know the client. I want to know their history, what their plan is. It's also, your mortgage is actually more than just buying a house. It's actually a financial tool that most people aren't using properly.
Right.
Right. And structuring it properly to do your long-term goal is really important. And people just, like you said, they just ask for the best rate, they sign, and they don't think about it for another 5 years. It's a lot of missed opportunities happening.
That's a really good point. And everyone has heard this, you should use other people's money to create wealth.
Right.
But using other people's money, a big part of it is using the bank's money, right?
Yes, that's who you want to use.
That's who you want to use.
Right.
That's why banks exist.
Right.
You leverage their money to create wealth for yourself.
And the banks have a lot of faith in real estate. I mean, they're willing to put down, if you're buying a new house, you only have to put down 5%, and the banks will lend you the 95%. What does that say about real estate? Right?
It says a lot about real estate, and that real estate is a solid investment, and everyone should own some real estate.
Right.
Some people might own a lot of real estate, but everyone should own some real estate. But if you're going to own, even say more than one property, most people are going to do it using the bank's money.
Ideally,
Ideally.
They should.
Yeah.
Because if they're not, then they're leaving. Like, why would you put 100% of your capital into it, right? If one of the big things that a lot of people are missing, that if you borrow funds to invest, the interest on those funds is tax deductible. So if you bought a property, this is what the rich do, right? They buy a property, first thing they do, leverage it. They borrow against it, and now they can go out and buy another property.
Yeah. It's kind of funny. It's so simple when you say it.
It sounds so simple. It's just money, right?
It's just math.
It's just math
It's
behind
just
it.
math. So and for someone that's maybe not well versed in it, they might look at it and say, well, it seems so complicated, and how do I make that work? I know what my income is. I know what my bills are. How could I possibly own more than one property? That seems like a monumental thing for a lot of people. But if the mathematics is there and you understand it, then you can make that happen for them.
Yes, and like you said, the math has to work. Obviously, the income needs to be there.
Right.
The down payment needs to be there. Now, if someone bought in Calgary in the last 5 years ago, they've got equity in their property. They have the down payment to buy that next place. So if their income is there to make the math work, then they can easily buy an investment property, and that's when the real magic starts to happen.
Which is a good segue into one of the reasons I invited you here today to be on this podcast with me is cash damming. And I know this is not a new concept, right?
No, it's been around since early 80s.
Early 80s, right. But what I liked is, when I met you and you explained it, is that I think with your engineering background, your mathematics background, you've been able to more simplify it. At least it sounds more simple. It's probably a little more complicated in the background, but it sounds a little more simple when you explain it. But you've got a fantastic way of explaining it and putting the path forward for someone to maybe leverage and own an additional property without really increasing your overhead. So I know you could probably talk a long time about this, but maybe you could describe it for everyone as to what that looks like.
Sure. So what you're doing is you're using the rental income to make the mortgage on your primary residence into a tax-deductible investment account.
Right.
So it's all about the cash flow and just moving the money around in the proper way to properly show the government where the funds are going and that it is an investment.
So it sounds like what you're saying is you're using the income from the rent to offset some of your own income to make the numbers work.
No, you're making additional payments on your primary mortgage, which is how you're paying it down faster, and then borrowing back against your mortgage to pay off the mortgage on the rental property.
Gotcha.
So, and that's where, the simple cash flow, it is a simple diagram. It's setting up the mortgage has to be done correctly in order to separate that interest cost on the investment property, because that's what the government's going to be looking at. And that has to be separated
So the tax deduction plays an important role in this.
It's huge.
Right.
Yeah.
So, and that was something new to me. Even when you showed it to me, it's like, wow, I can actually get a tax deduction
Yeah, because you're investing in real estate.
because I'm investing in real estate. The government allows it.
You bet.
Right.
Cash stemming is a term from the CRA.
So here's something that was when I got into business for myself many years ago. The first thing I learned, and I used to be the kind of person that would be looking for apples on sale at Safeway and looking for all the small sales, and then I realized my biggest expense is taxes. That's what I pay the most on. Hey, I'm not saying don't look for the sales on apples. That's fine, but I'm saying but most people don't realize they can save if they really pay attention to what they're doing and using the bank's money and leverage. You can create tax deductions, and this is exactly what we're talking about here.
That's right.
Yeah. So by getting a tax deduction, it makes the numbers work then to own two properties, essentially.
Well, you need the property in order to make the tax deduction.
Right.
Because it's the investment that's generating the tax deduction.
So let's just probably try to simplify it if you're watching this video as much as possible. I mean, obviously you can reach out to Karl if you really want to get into the weeds on this. But let's just say, for example, I own a property worth $700,000, and I've owned it for 5 years, so I do have maybe a fair amount of equity. I don't know. Let's say I've got $200,000 in equity. Would that be enough?
Definitely. Yeah, because you need 20% down to buy an investment property, right?
Right.
So $100,000. You can buy a $500,000 investment property.
So we just take the $100,000 out of my equity,
right?
And we use that to purchase the next property.
To purchase the next property, and that's really as complicated as the investor really needs to know. Like, obviously, I would go through all the details of it, but big picture, that's it.
Yeah, and so that sounds great. Of course, the first thought I have though is, okay, but if you're taking $100 grand on my property, like right now, I'm comfortable with my mortgage payments, but I don't really want my mortgage payments to be that much higher than I'm paying right now. So if we're going to take $100 grand on my property, aren't my payments going to go up?
No, because we actually put that into the cost of we use a HELOC,
right,
in order to do that, and all the additional costs go into the HELOC, and because that's being used for the investment purposes, is tax deductible.
So that's what really keeps my mortgage payment relatively close to what I'm paying now.
Correct. Oh, you won't see a change at all.
I won't see a change at all.
No.
Wow.
And in fact, if we actually refinance you and extend that amortization from 20 years to 30, we can actually drop your mortgage payments if that's already a stressor.
So what you're saying is, so just like that, without any additional cost, without dipping into my bank account, I can own another property, and now I've got rent coming in, I got tax deduction, so ultimately I could just end up owning both properties by the time I retire.
Correct. And it seems like magic, because all of a sudden you just have this another property, your payments haven't changed. What you've done is leverage the equity you had in your primary residence, and your tenants pay the mortgage essentially.
Yeah, fantastic. And I got to tell you, I mean, over the years, I've helped a lot of people buy the right property, and I can't emphasize this enough. And this is on my side of the fence. It does have to be the right property. Like, I mean, you want to buy a property where the cost of the property matches the rent that you can get, and obviously, getting good tenants. And I'm also on the property management side. So, and I think if we do the numbers right, you could probably end up with even having a management company like I have a division to my brokerage that handles that, where you could literally have a management company look after the property, and now you've got the property leverage, but you're not even involved in handling tenants or anything.
No, you can be completely hands-off.
Completely hands-off.
Right.
So you've got an investment that really doesn't have to worry about anything. Yeah.
Correct. And the appreciation that we see on the property value over 30 years is amazing.
Well,
right? Like, that's how you build generational wealth.
I mean, you just look at, I've been in the business now for 25 years, and I just think back to, if you bought a property in the summer of 2000, and like you said, what it would be worth now. So you can imagine if you do this today, this is why I like to focus on, or have people focus on what you can do for retirement, because I look at it and go, all right, let's say you bought one today, 25 years from now, you think about what that property could be worth. But secondly, you can make a decision. I mean, say you go to retire, well, you could just cash out, sell it. do whatever with the money, or just now keep the rental income coming in, property's paid off, so it's huge cash flow.
Right. And some people actually prefer to sell the rental property after about 10, 15 years and just be completely mortgage free.
On your first mortgage?
Completely.
Yeah.
Right? Because after 10 years, between the equity that you built up in that investment property, you're able to sell that, pay off your mortgage on your primary, and you're completely mortgage free and still have your primary residence. Obviously, you don't have the investment property anymore, but
you leveraged it to pay off your mortgage.
that's right. And you took 10 years off your mortgage.
Yeah, it just took 10 years off your mortgage, and so you can do whatever. So it's all about options.
Right.
Yeah. No, I think the program is absolutely amazing, and there's a lot of people doing this, right? I mean, it's.
Oh, yeah.
If you, I've noticed actually, even since COVID, I've been shocked at how many people have invested in revenue property.
Yes, but very few of them are doing the cash down, so they're missing out that opportunity.
They're missing out on the opportunity of the cash down. They don't, because no one really explained it to them.
No, because it sort of falls into a nowhere land, right? Like accountants aren't going to talk about it because they're not going to give financial advice. Financial advisors don't really talk about it because it doesn't fall into stocks, bonds, mutual funds. Mortgage brokers generally don't talk about it because we're mortgage brokers. We're not supposed to we're not giving financial advice.
You don't want to get into the weeds with tax advice.
Right. So it sort of falls into this nowhere land of it's in between disciplines. So therefore, no one really talks about it.
Makes sense.
And the banks don't want to talk about it because they don't want to help you.
Right. So if we don't have someone like you that can really understand it and go through the math, and I'll just tell you this, if you're watching this video, is Karl's great at really laying it out for you. When he talks about using spreadsheets, I can honestly tell you, you might be looking at this right now and still feel a little confused, and it almost sounds too good to be true. But I can tell you, Karl can lay it out for you very, very carefully and articulate it with you if you were to sit down and actually look at how those numbers work. Because he can take your situation, right?
Correct.
And fine tune it specifically for your particular situation.
Right, because it's great to hear about how Bob and Sally did something, but really, like, how does that pertain to you?
Right.
And that's really what matters. So that's why, I would get your actual numbers and run a scenario for you, and then we see the results, and then you take it from there.
Now, so that's obviously on the investment side, and I hope all of you really consider this. And also, by the way, never be afraid to reach out to me with questions on, what the rents look like on some of these properties and what would be a really good area of the city to buy these properties. We do property management in both Edmonton and Calgary, so we sell investment property in both cities. And I'm assuming it's fine if you live in Calgary and you want to buy an investment property in Edmonton, right?
Yeah, I'm licensed in all of Alberta.
Right.
And through my brokerage, we're nationwide, except Quebec.
Yeah. Because I do find it's been a little more challenging. I'm not saying, don't get me wrong, there's lots of opportunity in Calgary right now, but it's been a little more challenging to make the numbers work in Calgary. Edmonton's been a little easier. Mm-hmm. Their rents are good, and the prices are still quite a bit lower. Where on average, about a detached home is about $200,000 less in Edmonton and Calgary. So the numbers can work a little bit easier in Edmonton. And sometimes people from Calgary, when they think of Edmonton, they go, I don't want to think of Edmonton. But from an investment standpoint, we're not asking you to live there. We're just saying this is an option to consider. And I've directed some people to Edmonton, and we've helped them out and to found them property there. So, but I think what it comes down to, it's all about making the numbers work, right? The rents have to work. The equity you have to have work. It's math. That's the word.
It's math equation.
It's just math equation.
Yeah.
So
as you're talking about that, the thing that a lot of people are missing too is having an owner occupied with a rental suite, right? Like that rental income obviously is a huge offset to to paying off your mortgage, and it also allows you to qualify for a much higher amount as well.
Yeah. And a lot of people have caught on to that, and this is why I'm repeating myself, but you have to be smart about what you're buying, because there's I know even right now there's some builders that are suggesting some pretty high rental amounts in some of these legal suites down below, and they're definitely quoting some numbers that are a little higher. And the thing is, the lender might even take it, but realistically, when you go to rent them, they're not quite getting what what the builders are telling you. So,
Right.
so you do have to be smart about that. Now, also just talking about the lenders. I mean, is there? I mean, you say you're working mathematics, but is it still matching the right lender to the client as well to do this?
Oh, definitely. Because in order to cash down, we need a very specific mortgage product.
Right.
Which, yeah, it actually ties our hands to about 4 or 5 specific lenders that we have to pick from. And sometimes, and that too, when we're talking about it, those lenders might not have the best rate. So if you want the best rate, well, you have to go over here. But if you want to do cash downing, then we need to put you up with one of these other lenders. And the rate might be, 0.1, 0.2% higher. But when you're seeing $40,000, $50,000 in tax savings, that 0.1% doesn't really add up to too much.
Right. So that's why the interest rate is only one part of the equation.
One thing to consider. Like I
Yeah.
said, there's still a couple of lenders that we can pick from, so we pick from those.
And often these lenders, are they lenders that a lot of people aren't even familiar with?
There's a mix, yeah. I mean, one that really surprises a lot of people is Manulife.
Right.
Because everyone thinks Manulife insurance.
Right.
They actually have a very good structure to do cash downing.
Yeah. Even I haven't even dealt with Manulife on mortgages. So, but it seems like every time I turn around, there's another lender that I've never heard of. So
There's a lot of them out there.
We have a lot of them out there in
Yeah.
Canada, but I know oftentimes people just think of the the lender that they drive by on the way to their office every morning, right?
And there's a big opportunity to be missed, right? Because the banks follow their very strict guidelines, and not everyone falls into those guidelines.
Yeah. So if and by the way, if I was to reach out to you, Karl, and I was just curious about this, and I was to sit down with you, I mean, do you charge me a consultation fee to do that?
No.
You don't?
No.
Okay. So we could just meet in person, jump on a Zoom call, whatever, and just look at my situation.
I was going to say Zoom calls are actually best because that way I can have this, I can share the spreadsheet I've developed for you guys.
Right.
You'll see it on your screen and we can talk about it. It's a lot easier to do that instead of sitting beside a little laptop and going through it, or someone on their phone.
And by the way, I'm no different. I mean, I do consultations all the time with people who are just trying to get some information to start this, just to see if it really is something that would interest them. And I do the same thing. We talk about rents. We talk about what areas of the city, what kind of properties you want to focus in on. All of that is part of the equation, because this is, if you're going to have an investment property, like I said, you got to be smart about it. You have to be smart about it. You can't just buy anything, and you've got to work with the right people to make sure you're making a good decision.
It's a huge financial decision.
Right.
But making the right decision is going to set you up for you and your family for life.
Yeah. It's a well-known fact. Most people create wealth through real estate.
Right.
They really do. It's one of the best ways of creating wealth if you do it right. And far too many people, unfortunately, I've seen them, did not take advantage of this, and it's sad because it's right here. Easy to do, very easy to do. So, what about just regular mortgages, though? Maybe I'm buying my first house.
Right.
That sounds like a little simpler than the cash downing.
It is, but still, I mean, it's the first-time home buyer. There's a lot going, like, they have never gone through this. And what's their education about it? Probably not much, because we're not taught this in school, how to buy a house.
Right.
They don't know what questions to ask, and how do you ask what you don't know what to ask, right? A lot of people, first-time home buyers, are missing out on the first home savings account.
Right.
Right, and that's easily at least $2,000 of a tax deduction that people are missing out on simply because they don't know about it.
Mm-hmm.
So there too, it's reach out, talk to someone, and get information.
And the consultation is still free.
You bet.
All right.
Always.
And what about if I just want to, I've got let's just say, for example, right now I'm in a home. I'm thinking about buying another home. I'm tired of the one I'm in. I want to sell it. I want to buy another home that's maybe a little bigger, nicer, whatever it is. And I'm maybe right now I'm still on the tail end of my lower interest rate. Maybe I got another year left at that low rate.
Right.
I was lucky enough to lock in before they went up. But I don't want to lose that rate either. Could I take that rate to the next house if I wanted to?
You can port your mortgage. You bet. Of course, the lenders will be looking for any way to not allow you to do that, right?
Right.
Because obviously, they want to break those low interest ones and get you into more higher rates. Of course, you can only port how much you actually have left, right? So if you've got $300,000 on your mortgage and you're upgrading and you're going to have a mortgage for $500,000, well, that extra $200,000 is still going to be at the new rate. So they might do a blend type thing, but then there too, they'll be looking for ways to, make you break your mortgage. Of course, my first question would be like, well, don't sell your house, keep it, make it become an investment property, buy your next house, move, rent it out, and then start cash damming.
Oh, there you go.
And use that property at least for a year.
Sure.
To help pay for your next home.
Yeah. Another reason to do cash damming. That's right. Just keep that property.
Just keep it.
Yeah. Yeah. Well, I know I hate when I hear this, but I remember a wise man once said to me, "Never sell, just buy more real estate." I was like, but I do like working with sellers too. But there's a time and a place for that. But I think it's a very good point. Maybe you hadn't even thought about keeping that property because you were thinking, well, I got to take my equity out of it to buy the next one.
Right. And a lot of people, and yes, for the down payment, if you don't have cash available for down payment, but that's where we can refinance it, take the cash out for the down payment, and still, if the equity is there, and then still keep the current property for the investment purposes.
I think, now that we've done this podcast with you, Karl, I can summarize this very easily. Whatever it is I'm thinking I want to do, we should talk to Karl, and Karl can go over what those options are, whatever they are. If you're committed to just moving and selling, no problem. There's a strategy with that. Maybe the cash damming, keep the house. I love it. Buy another one, use it as a rental. That's another option. But I just love the fact that you've got all these options, because I do know from my own experience, if I go to the bank doesn't usually shout out options. They just like, oh, you want to do this? Okay, we'll see if we can do it the way you don't know what you don't know.
They're order takers.
They're order takers. That's right. Yeah. No one is thinking outside the box. They're listening to what you think you want to do, and they're like, well, I'll see if I can make that happen for you. But there is no suggestions of other options that you could consider.
No.
And I think it's safe to say anybody who's watching this options are great. There's nothing better than having a few options to consider. Look at them all and figure out which one might be the best one, as opposed to you just coming up with what you think is what you want to do. Even me on the real estate side, I can't even tell you how many times I've had people that'll say, well, I'm looking at this particular property, this particular neighborhood, at this particular budget. And I always look a little past that to think about their lifestyle and what they're trying to achieve. And sometimes I'll call them up and say, well, you know what, I've got an option here. It's not exactly what you said to me that you wanted to do, but I think it's an option to consider. Can't even tell you how many times I sold them a property. It wasn't specifically in the area that they thought. It looked a little different than they thought it was going to look, but they said to me, you nailed it. This was the house. But it's reading between the lines and
knowing your client.
That is the difference between order taking, is that it's a very personal relationship with our clients. We get to know them, we understand them, and we just look past that. So a combination of the right property, the right situation, and the math all come together, and it can work. So our final would be to invite anyone to reach out to us. There's, as Karl said, there's no cost for the consultation. It's not going to hurt to at least know what your options are and get an understanding of what you could do. And maybe even if you're not quite ready yet, you could at least get some information to start things out. So go ahead and leave your comments below, and have any questions. I mean, we answer to all the comments and questions, so just go ahead and do that.